Hi everyone, my name is Shaun Peterson. Welcome to Peterson Wealth Services Point of View. Today is April 26, 2022, and we've made it through tax season, and I wanted to spend a little bit of time talking about taxes and the way we invest around those and what can trigger capital gains or dividends or interest, because we've had some clients call and say, hey, my accountant said that I booked a lot of gains in my account, and why is that happening? So here's why it's happening. When we're building a model or we're going to invest money, we start with percentages. So if I have Tesla in my model, which we do right now, and it starts at a 3% position. So on a $100,000 account, that's going to be $3,000 being invested in Tesla. And then let's say 6 months later, Tesla does really well and it's grown in price. And now it's a 6% position in our model. And we look at that and we say, wow, Tesla has doubled where we wanted it to start. So we might sit down and say, you know what? I think it's time to rebalance and bring Tesla back to its 3% position. So that means we booked some gains. That's a realized gain in Tesla. And what we do with those gains is when you rebalance, we're going to invest in a company that maybe started at 3%, and I'm just using 3%, it could be any percent, and maybe it went down to 2%. So those gains in Tesla that we booked, they'll be rebalanced into a position that's maybe down in value. When we're looking at that, well, that's a good buying opportunity. That's the point of rebalancing. It's taking gains off the table and then maybe buying companies or funds that are at a lower value at that time in hopes that they will appreciate. Okay? Now we try to minimize that, believe me. We're trying to do tax loss harvesting at the end of the year. We're trying to avoid capital gain distributions from mutual funds. We'll talk about that. But we can't always just let things run all the time. Think about that. We went in the last year and all these tech companies just ran up like crazy. And we're looking at P/E ratios and all the indicators that we research, and we're saying, hey, we need to take some of our profits off of that. And let's rotate this because we don't feel like this can last. So we went into things like banks that were undervalued. We went into some oil and gas companies that we felt were undervalued, some commodity stuff. And that's done really well for us this year. And tech, if you've been watching this year, has really been getting hurt. So we felt like that was a very smart move to do. But still, it did book capital gains. It booked taxable gains for clients. So it can be a little bit frustrating, but it's better than holding on to something for too long. So when we're managing money, believe me, taxes is really top of mind, but we don't want to let that guide everything when we're making our portfolio decisions. Another thing that happened last year. So if we have mutual funds, and I'm going to represent a mutual fund by this circle here, and we have companies in that mutual fund. It could be, we'll just stick with the Tesla example. It could be Apple is in there. It could be Home Depot. And hundreds of different companies inside one mutual fund. And let's say the fund manager is looking at his or her portfolio and they say, you know what? Apple has done really good. I'm gonna take some profits, so I'm going to decrease my position in Apple. Well, that booked gains. And then they might say, you know what? Home Depot has done extremely well. I'm gonna sell all of that at a gain. So then you, as a shareholder in the mutual fund, when they do a capital gain distribution, you're going to owe a percentage of that capital gain. So that happened a lot last year, where mutual fund companies had distributed some capital gains that they've been holding on to. Now we can try to avoid this. Let's say we recently go into a fund and then we find out, and by the way, this doesn't happen immediately. We usually find out about these towards the end of the year, but say we found out, okay, we just bought a fund a month ago, now it's December, they're going to issue a 5% capital gain, and it really hasn't made or lost money. It's just kind of been even for people. Well, we might decide to sell that fund, avoid the 5% capital gain, and then buy into that fund at a later date so we can avoid that for our clients. But maybe it's a long-term fund, and it's up 50, 60%, and they're going to issue a capital gain of 5%. Well, if we sell it, we're going to book that 50 or 60% gain to avoid a 5% capital gain distribution, and that wouldn't make sense to us. So as mutual fund investors, we have to be prepared for that they are going to issue gains to shareholders. We're trying to do the best we can to avoid those when it's possible. But again, we don't want to let that be our number one priority when we're investing for people. Our number one goal is to protect and grow your money in the best way possible. Things that are going on right now in the market, we know it's volatile. Okay, we're watching the news. We know it can be a very scary time, but I'll just kind of go back to my experience when I'm sitting down with clients, me, Billy, and Cade, and we're going over reviews. And the clients that take advantage of this, where they're adding to their accounts when possible, even if it's a small amount, we think it makes a lot of sense to add when markets are down. And I know we pound the table on that. And it's not just a repeating record. It's not for our benefit. It's because we have seen the clients that do that typically are outperforming clients that don't do that, that want to either sell or make crazy decisions. Those clients typically underperform clients that are saying, hey, give me your advice. What do you think I should do here? Let's do this. And they do it with confidence. We're never going to time it perfect, and hindsight's always 20/20. But if you look at a 6-month window in a 20, 30, 40-year retirement or investment lifespan, it's not going to, you'll forget it. I mean, I look at reviews now, and we can all see the drop of March 2020, and it's a little blip on the radar already. So focusing on long-term, doing what you can. And some people say, you know what? I'm retired. I don't have the ability to add anymore. That's where you need to lean on us. You need to lean on our advice, our guidance. It's just like you're on a cruise line or a cruise ship and rough waters come. You can't jump out and try to swim for shore. You've got to let someone that's got the experience, that have been through these before, guide you through that. Call us. We're here to chat. If you have any questions about your own personal situation, tax situation, we're happy to discuss that with you. Thanks again.